What if I told you you could help your 16-year-old child save enough money in 2 years to potentially have close to $50,000 tax-free when they retire, and it would cost you about what you were paying for their cell phone? Is that a lesson worth teaching? Stay tuned. Teaching your child to save, the parent-sponsored 401k, coming up. Hey everyone, it's Jeff Drayton, Certified Financial Planner Professional and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. Here, I share my thoughts on financial planning topics for individuals and households. If you're watching this on YouTube, go ahead and subscribe. And if you're viewing this from my website, fill out that sign-up form at the top of the blog page so that we can contact you when new content becomes available. A question I get asked every so often is, how do I teach my child about money and saving? This frequently comes up at about that point when one's son or daughter gets his or her first job, right around age 16. Your child is now earning a paycheck, bringing home some of their own money, and you would like them to understand something about saving, setting aside some amount of money for their future. Well, that's a great lesson to teach. And so I've come up with an idea. It's an idea I call the parent-sponsored 401k. Let me tell you how it works. First, something you should know is this. When your child started working and having their own earned income, they actually became eligible to start saving in a tax-advantaged retirement savings plan. Possibly their employer will offer them a 401k, but I wouldn't bet on it. Not only is it not uncommon for a benefit such as a 401k to not be offered for the type of minimum wage, part-time employment that high school students typically have, even if it were, employers are not actually required to include workers in their 401k plan if they haven't worked for the company for at least a year and if they have not yet reached the age of 21. But here's the good news. A 401k is not their only option. Because they have earned income, they can have an individual retirement account, an IRA. You see, having earned income is the primary requirement for a person to contribute to an IRA. And for IRAs, there is no age requirement. A 6-month-old getting paid to do a baby food commercial has earned income and therefore can have an IRA. So, if I'm talking about an IRA, why do I call my idea the parent-sponsored 401k? Well, for a couple of reasons. The first is, a traditional 401k and a traditional IRA have a lot in common. They both allow you to put money into the account tax deferred, and any earnings or income generated in the account will also be tax deferred until such time as that money is withdrawn. The primary difference between these two types of accounts is a 401k is an employer-sponsored plan and an IRA is simply established by an individual through a brokerage firm, hence the I for individual in IRA. But there's also a second reason. How is it that employers encourage their employees to participate in their 401k plan? Well, very likely, they offer those employees matching contributions, meaning if the employee puts money into the 401k, the employer will make some sort of a match. And here's where you come in, Mom and Dad. My suggestion is this. When your son or daughter gets his or her first job, you help them establish an IRA and you then make them this deal. If your son or daughter agrees to contribute $25 from their earnings into their IRA each month, you will agree to match it, 2 for 1. You'll put in $50, probably about what you are paying each month for their cell phone. And what's more, you'll tell them if they don't miss a month, meaning at the end of the year they have contributed 12 times 25 or $300, they'll get a bonus $100 contribution from you. They will have put in $300 and you will have put in $700 for a total $1,000 contribution. Yes, I realize that's a 233% match, far better than they will ever receive from any employer, but hey, this is your child we're talking about. They'll be out in the cold, cruel world learning the harsh reality of true employer matches soon enough. There are a couple of moving parts to this plan that you will need to be aware of. First, let's talk IRA contribution rules. I am making this video in 2019, and in 2019, the most an individual can contribute to an IRA is $6,000. So feel free to tweak my plan, but just know you can't go over that. And also, remember how I said that as a result of your child having earned income, they can contribute to an IRA? Well, their contributions need to have come from that, their earnings. Meaning, regardless of the $6,000 limit, the most that they can contribute is also limited by however much they earned for the year. Technically, their IRA contributions come from their earnings. Your match is a gift to them that will replace their income that they have set aside in their IRA account. And here's another point. You and your child will also need to decide whether you should establish this as a traditional IRA or as a Roth. I'm not going to go into the differences between Roth and traditional IRAs here. However, I did do a rather long video on that topic some months ago that I will link to below. A summary is this. The decision is basically a determination of whether you think the taxes to be paid will be higher now at the time of contribution or later when the money is withdrawn. If this is a teenage child and this job is their only income, I can't imagine that the equation wouldn't favor establishing the IRA as a Roth. However, that might be a question to ask your financial professional. And finally, a question. Will encouraging your child to establish a Roth IRA when they are 16 and helping ensure that they contribute $1,000 of their earnings each year really have a financial impact? Or is this just a good lesson on saving, but the dollar amounts are really too small to ever have any real significance? Well, let's do some math. If your son or daughter contributed $1,000 a year for 2 years, say ages 16 and 17, and they earned a 10% return, a side note here, I'm being a bit aggressive in what I am projecting for an investment return. If you do not anticipate that they will need this money in the near future, and possibly they won't touch this money until retirement, well, retirement at age 65 for a 16-year-old is 49 years away. They can afford to be a bit aggressive in their investment choices. At the end of 2 years, their savings will be worth about $2,100. Not so much. But now imagine that they do not touch that $2,100 until they retire at age 65. 47 years later, that $2,100 is now worth $185,215. If the account they established were a Roth individual retirement account, that $185,000 and change is also now 100% tax-free. Now, to be accurate, this is 49 years from now, and 49 years from today, $185,000 won't be worth what $185,000 is worth today. So, let me adjust this for inflation. Assuming a 3% inflation rate against our 10% return, that means that in today's dollars, that savings will be worth $45,462, assuming your child never added another dime to the account beyond the $2,000 that was originally contributed when they were ages 16 and 17. According to NerdWallet, the median household retirement savings for Americans between the ages of 65 and 74 is $126,000. Therefore, what you would have helped your child save in those 2 years of high school would be over a third of what the median household retirement savings is for Americans reaching retirement age. And it would have cost you an amount of money similar to what you are paying for their cell phone for 2 years. I'm Jeff Drayton. Thanks for watching. Nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. I would encourage you to seek out someone who is a certified financial planner. This is signified by the letters CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's 2 words, fee only, not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.